Hello again. Now, South Africans have endured 6 consecutive interest rate hikes since November 2021, and it doesn't look like there's any chance of a reprieve soon. It's a necessary evil, with the Reserve Bank trying to curb inflation. But as necessary as it may be, it's been tough going for many South Africans with debt repayments. So what does the crystal ball say for 2023? What is the outlook like? Just last month, Stats SA announced that annual consumer inflation had dropped to 7.4% in November, still higher than the Reserve Bank's target. But could it signal a shift, an easing off somewhat? Well, let's get some insight from Nicky Weimar, who is the chief economist at Nedbank. Nicky, good afternoon. Welcome to today, and thank you very much for your time. So, firstly, an overriding question. With inflation coming down like it did in November, and just the other day, we are now paying less for diesel and petrol after this drop that we just experienced this week. Should we be expecting an easing of the interest rate hike cycle by the Reserve Bank in the next few months or not?
I think the key reason here being that although inflation will come down quite substantially as a result of that cut in petrol and diesel prices that we saw in January. So the latest set of numbers we have, as you've rightly said, is for November, where we've seen inflation easing slightly from its peak of 7.8% in July last year to 7.4%. So during the course of last year, it was coming down very slowly. It probably declined a little bit more as we went into December to around 7%. And now this petrol and diesel price cut in January, which was a big one, just petrol on its own, on a month-on-month basis, that's a decline of over 8%. That will probably bring it down to about 6.8% in January. So then you're still miles above where the Reserve Bank would like to see inflation, which is for it to be stable between the 3 to 6% band. But what the Reserve Bank really targets is 4.5%, which is the midpoint of our inflation band. And you'll agree with me, 6.8 is still very far away from that. And they obviously would like to see a very firm and well-established downward trend in inflation before they ease in terms of interest rates. The other thing that is out there that they need to be aware of is, of course, the Rand. Now, the Rand actually started this year, ended last year, started this year on a slightly firmer footing. A lot of that has had to do with the fact that the dollar has weakened quite a bit. But we do know that the general expectation is that US interest rates might increase a little bit further. And as long as that's the case, the Rand's very vulnerable. The Reserve Bank still has to attract capital to this country. And so as a result, they're not going to cut rates. That is just not going to happen. So we see another 2 hikes of 25 basis points in the first half of this year. And we'll probably have interest rates peak in March. And from there on, it's probably going to stay at that level. If inflation comes down very quickly, maybe we'll see a cut towards the end of next year.
What factors could put the spanner in the works, Nicky?
What factors could put the spanner in the works? Yes, I think the Rand's very vulnerable. If we see the Rand fall very sharply, that's obviously over the longer term going to be inflationary, and the Reserve Bank will become even more cautious in terms of how they act in interest rates. And it's going to take a lot longer for inflation to come down to levels that is lower and that helps to sort of boost households' purchasing power. Then the other worry, of course, would be oil prices. Now, we still got a war going on between Russia and Ukraine. The general expectation is that it's sort of going to stall over their winter. And as a result of that, you might have a bit of a quieter spell. But if you see any kind of escalation in that war, any kind of impact even further on oil supplies, then that could come back in the form of higher global oil prices, which of course directly translate into higher diesel and petrol prices in South Africa. and is therefore also inflationary. So that's a worry. Generally speaking, at this point, though, I think the world economy is slowing. And when the world economy slows, it's very unusual for oil prices to continue rising. So I think at this point, we're fairly safe on that score, but it is a function of the war. And then, of course, global warming, climate change, extreme weather events could affect agricultural production. Again, we're in a much better space globally as far as that's concerned. So it looks like food prices should eventually start to ease. But again, it's a risk and it's an uncertainty. And therefore, you're never 100% sure how that will play out. And then another big element in food prices, of course, that the deal between the UN, that the UN and Turkey brokered between Russia and Ukraine in terms of the exports of their grain must hold. If that does not hold, you could again see grain prices rising internationally, and that could put pressure on domestic prices. So there is that. And then the final spanner in the works could be electricity tariffs. But we're pretty certain that is anyway well above inflation. And we already know what the settlement is going to be for this year. So that removes that uncertainty. So it's the rand, it's global oil prices, it's food prices. Those are the big unknowns.
Yes, and of course, the whole issue of electricity. Finally, Nick, and very briefly, if you may, I've seen some reports sort of talking about the world. You said the economy of the world is slowing down, but some people are using the R word, recessionary. Are we headed there?
I think that it actually takes quite a lot to achieve a global recession. It's not a very common thing. US recessions more common, UK recessions, South African recessions, but for the world economy to enter recession is not actually easy to achieve. And I think it's unlikely because China is opening up. If China's growth disappoints, if they have vicious waves of COVID and as a result, again, have to go the route of locking everything down, then we can possibly talk about global recession. But with them looking like they are aiming at keeping their economy open, it appears to me less likely that you'll have global recession. But I think the key point here is you're definitely going to have a global downturn. You're definitely going to have slower growth globally. And South Africa will feel the effects of that in terms of our exports. And, you know, I think for a lot of countries, because of high inflation, because of the cost of living crisis, because of higher interest rates, even though it may not be technically a recession, it's going to feel like a recession.
Thank you very much, Nicky Weimar, who is the chief economist at Nedbank. Some of her insights and her outlook as in South Africa in terms of inflation and interest rates, and of course the rest of it.